Over the last month, the majority of dividend-paying companies are down in the red, giving us an excellent opportunity to find undervalued companies. Today, we're focusing on 5 undervalued dividend stocks. We're going to run through each one of these historically. We're also going to take a look at their dividend safety, their underlying metrics. Now, each one of these stocks has a very safe dividend score and have some very strong upside over the next 12 months. And for each one, as always, we will put them through the valuation model, getting to our intrinsic value and our acceptable buy price. Remember, we do incorporate a margin of safety, and we'll also look at Wall Street to see their exact price target over the next 12-month period. So let's jump into the first dividend stock. It is Medtronic. We do have a double buy rating, Seeking Alpha and Wall Street, with a hold from Quant. It is trading in the midpoint of the 52-week range. It does have a nice starting forward yield, 3.46%, and a forward P of 15. Just bear in mind, S&P right now sits at 22, but as always, we will focus on the sector P to be more relevant. Over the last 12 months, well, it hasn't had a great year. It is down around 8%. But if you have been a longer term shareholder, you can see you would be on a bit of a roller coaster ride. In fact, all-time highs are $135 summer of 2021, so nearly 3 years ago. In terms of the dividend safety, well, as we said, every single one of these stocks, a very safe score. In fact, Medtronic with the best score obtainable at 99, market cap just over 100 billion. It is a mega cap company and just reaffirmed last week their very safe score, indicating a dividend cut looking to be highly unlikely for MDT. Now, in terms of the last recession, well, how did they perform? They increased the dividend during the 07-09 Great Recession. Pretty much flat recession sales, though above the average of the S&P that sat around -12, and we do see pretty much a near S&P return, -56, with the S&P returning -55. Now, last month, not the greatest in terms of the dividend increase, 1.4%. Bear in mind, on this channel, we want a minimum inflationary target of 4% or more. Over the last 5 years, nice high single digits. In terms of the last 20, though, double digits. Again, one of the reasons why we were disappointed with the trivial 1.4% increase in terms of that dividend. Now, 46 years of consecutive increasing, meaning they are 4 years away from becoming a dividend king. And when we take a look at dividend yield theory, as always, one of the elements of our analysis, and for those that are new, it states a company is undervalued when the current yield sits above the 5-year average. So right now, one severe sign of undervaluation, but also on the forward P, just below 15 with the 5-year rolling at 18. And when we do take a look at the healthcare sector, it does sit higher at 16.6. So we have a triple undervaluation signal for MDT. Just bear in mind, though, we're not looking at any of these models in isolation. We will conclude towards the end. As always, though, free cash flow payout over any earnings data because it can be susceptible to manipulation by management through accounting, and essentially below 60% is our target. Typically, that gives us faith that management can offer those double-digit increases we love to see. What we have noted, though, with Medtronic, it is above 60% over the last 2 years. What is positive to note, though, 2025, the next full year, it is expected to be brought down to 55%, so hopefully we can see a nice increase to the dividend next year. Free cash flow per share, as always, target increasing free cash flows and very consistent ones over the longer term. Medtronic, we do see minimal growth over the last 10 years, very inconsistent as well. The positive to take, though, 2025 expected a nice increase to that free cash flow per share. In terms of sales growth, well, very commonly we do anticipate 3 to 7% growth for the majority of companies. Baseline growth, and to be fair, with Medtronic, we do see them pretty much hit that in the majority of the last 10 years, although we can see 2 of them have unfortunately been negative. And when we look at it in terms of the longer term, we can see the top line has gone from 20 billion in 2015 to 32 in 2024. Just bear in mind the type of company we are looking at. It isn't a tech or a fast-growing company, so always implement some realistic expectations. In terms of shares outstanding, returning excess cash to investor pockets, well, they would have diluted your position over the longer term, but again, does depend on when you did invest into this company. From 2016 onwards, though, we can see they have been doing share buybacks, although very minimally and very trivially. In terms of the ROIC, a very important metric, in fact, one of my favorites that I do like to look at very closely for any company I invest in. 10% or more is my target, and that gives me faith that management are able to effectively allocate their capital. Over the longer term, it has straddled around that 9% in 2024, not too far off that minimum that I like to see. In terms of the operating margin, well, a positive to note here, it is above that 12% minimum, but no real growth over the longer term. In fact, you could argue operational deficiency, as it has in fact started to come down from 25%, but from 2016, pretty much in line year on year. In terms of the free cash flow margin, well, above that minimum 5% and pretty consistently in the mid-teens, so a good sign. This does make it attractive when investors are looking at these type of numbers. And in terms of the final metric, net debt to EBITDA, so that is the earnings before the interest, the tax, depreciation, amortization. Remember, we want below 3 because each one of these numbers signals the number of years it would take the company to pay off all of that debt net of cash on hand. And this does correlate to balance sheet strength, dividend safety. It is in a decreasing trend over the last 10 years, so a good sign. 1.71 anticipated over the next 12 months, so we can already see why this has a very safe dividend score and the balance sheet does look to be very strong. So let's jump into the valuation model, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you can be continually notified of these videos as they drop. And typically on our deep dives on the channel, we run through every single one of those models. Today, let's get straight into the final intrinsic value calculation, and it does arrive at just over $103. Now, the price right now, $81. As always, we want to implement a margin of safety, and we always start off at 10%, and we don't execute unless it hits that 10% level, and that is if it meets the 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that for MDT, we'll buy up to $93, and then we keep going till it's near the current trading price. And what we can see in today's episode, not at a 25% MOS level, but at least at a 20% margin of safety that is based on the estimates and judgments today. In terms of Wall Street, though, they do see upside, not as high as our intrinsic value, but their price target just under $97, indicating implied upside of 20%. So 20% margin of safety and 20% upside from Wall Street. As always, as we go through, let us know your thoughts below. Now, just before we move on to the next stock, just to let you know, we've released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment. You can read instant access straight away. For example, if you want to see the websites that we use, the resources, the screeners, click on this article, or our more recent articles looking at 12 high-quality undervalued dividend stocks. The next stock we're looking at under $100 is Nike, and what we can see, down 17% over the last 12 months, trading towards its 52-week lows with a buy rating from Wall Street, a hold, however, from the other 2 analysts. In terms of the forward yield, well, 1.6%. Forward P sitting around 25.22. And if you are a longer term shareholder, well, you would be up 150%. Again, if you reinvest dividends, it would be slightly higher. And as we can see, all-time highs sitting at the back end of 2021 at near that $180 mark. So in terms of the dividend safety, as we said, each one has a very safe score in today's episode. 99, highest score obtainable with a 141 billion market cap. Again, a mega cap company. And again, similar to essentially a Medtronic, dividend safety score, seeming that a dividend cut is highly unlikely. Now, last recession, they increased the dividend, they had above average growth, and they also did significantly outperform the S&P with their negative 36% return. Dividend growth, well, last November, high single digit, nice to note, double digit as well to report over the last 5 and the last 20 years, so a nice historical dividend growth company, and they have been increasing those for 21 consecutive years, making them 4 years away from gaining that dividend aristocrat status. Now, in terms of dividend yield theory, well, a double undervaluation signal, the yield one of the highest on offer over the last 5 years, and in terms of the forward P, 24.4, that is significantly lower than the 5-year average of 31.9. However, one thing we do point out, the consumer discretionary sector P does sit much lower at 13.9. In terms of the free cash flow payout, well, significantly below 60%, pretty much 9 out of the last 10 years, 42% over the last 2 years, 33% anticipated in 2024, so looking very positive for Nike. So great thing to see, as that does mean that we can expect some nice increase to the dividend this year. In terms of free cash flow, well, pretty nice in my opinion. I mean, it has been increasing over the longer term. You do get that justifiable dip in terms of COVID down to 90 cents per share. but since then it has been increasing, although a little bit inconsistently. Nice to report over the next 12 months that increase is expected to continue, and in terms of their sales growth, looking very strong, historically doing much better than the 3 to 7%. We can see the more recent year at 10%, although we should point out that on a trailing 12-month basis, it is up only 2%, low single digit. Numerically speaking though, they have nearly doubled their top line over the last 10 years, and whilst they do share buybacks, it is always great to see. It isn't very consistent and it isn't a large amount year on year. Nonetheless, when you incorporate this as well as the dividend increases, it is always a great sign for investors. ROIC, well above the minimums that we want to see here, and in fact, even though it has been decreasing over the more recent period, 22% over the last 2 years, still very strong and something we all love to see as shareholders. In terms of operating margin, well again, it does straddle around the 12%, some years a little bit higher, some years a little bit lower, and with the free cash flow margin every single year, bar that COVID year, looking very strong, very healthy, 12% on a trailing 12-month basis, also something nice to report. Balance sheet, well, they have a phenomenal balance sheet, 0.19 in 2023, there or thereabouts in 2024, so that does look good. That is one of the reasons why we do see that very safe dividend score as well, so I love that. That is one of the things alongside a nice ROIC that I want to see when investing in companies. And now when we jump into the valuation, always important if you do want to add a company that you buy it at the right price with sufficient margin of safety. And as a reminder, you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and the acceptable buy price of companies in your own portfolio. Margin of safety then, well, 10% a buy up to $101, 15% up to $95. As we can see, not quite at a 20% MOS level just yet, but at least a 15% up to around $96. In terms of Wall Street, well, they see this as a buy. Their price target, in fact, pretty much there or thereabouts of our intrinsic value, implied upside of 20%, again, making it one that you should consider for your portfolio if you do like this company for the longer term. We then move on to Cisco Systems, and we do in fact get a double buy rating, although a hold from Quant. This is trading right there at their 52-week low, and it has been down 10% over the last 12 months. Over the last 10 years, however, up 83%, and we can see their most recent all-time highs at $63. In terms of forward yield, well, this is quite attractive, 3.5%. In terms of a forward P, 12.29 as well. And again, another very safe dividend score, 91 out of 99. Market cap as well, 184 billion, a mega cap company. So as always, they do reaffirm this, and we can see just a few weeks ago, dividend cut does look to be highly unlikely. And when we look at their last recession, well, they didn't pay a dividend, so no comparative data. Average growth, and not too dissimilar from the S&P's return with a negative 59%. Dividend growth, not the greatest. Again, you want really 4%. The reason why we always bang on about a 4% inflationary increase is because the US inflation rate over the last 40 years was 4%. If you're not getting at least that, whether it's your dividends, your salary, your other income producing assets, you are effectively taking a pay cut and losing your purchasing power, at least over the last 5 years in line with inflation. Over the last 10 years, 10%, that is nice to know. In terms of increases, well, that is 12 years of consecutive increases. And when we look at dividend yield theory, another double undervaluation signal, 3.5 on the yield, as well as 13.2 on the forward PE. And we do note the information technology sector PE sits much higher at 27.2. But again, do bear in mind, it could be justifiable. There could be a lot more growth in terms of those that are grouped within this sector. We then focus on the free cash flow payout, and what we can see, not even 1 year above 60%, 33 in 2023, 44 anticipated over the next 12 months. So again, looking positive with respect to the dividend. With respect to the free cash flow, what we can see here, increases over the longer term. In fact, more than doubled from 2014 to 2023, though we should point out over the next 12 months, it is anticipated to drop down to 364. In terms of sales growth, well, never great to see 3 of the 10 years being negative, but what is nice to note, over the last full year, strong double-digit growth. On a trailing 12-month, though, we do see this down at around 1%. In terms of numericals, well, when you do look at it from a graphical perspective, you can see that the growth hasn't been as strong as maybe you would like. So definitely something to keep an eye on when you do look at the forward guidance of this company from their latest quarterly report. But what is very nice to note, they've bought back more than 1 billion shares outstanding over the last 10 years. Again, whilst it may not be consistent, always a great sign if you are liking a company and you do want to consider to add this. ROIC, well, in fact, increasing over longer term, so very positive, 29% over the last full year, although we do see a drop to the trailing 12 month, but still even 19% if it is over the next full year, that is still very nice to know. Operational efficiency, because it has increased over the last 10 years, 22% to 27%, and the free cash flow margin, surprisingly maybe, is very strong for Cisco, 33% over the last full year, 23% on a trailing 12-month basis. This does look like a fairly nice and maybe under the radar free cash flow machine. Net debt to EBITDA, absolutely phenomenal. It wouldn't even take them one day to pay off all of their debt last year and over the last 10 years, and even though it does expect to increase over the next 12 months, still very healthy, looking very strong, and again, no surprises why we do essentially note that very safe dividend score. How about the valuation, you ask? Well, let's get straight into that, and in today's episode, it is the average of these three, just under $61. Now, with a margin of safety of 10%, indicating a buy up to $55, 15% will a buy up to $52. At 20%, again, still showing a buy. We can see at a 25% MOS level, it is indicating a buy, pretty much 5 cents away from the current trading price. And when we take a look at Wall Street, they're indicating upside of 20%. So with Cisco Systems, a 25% MOS level and 20% implied upside, definitely again one you should consider if this is one that you do believe over the longer term will perform very well. We then draw your attention to Comcast Corporation, where in fact a triple buy rating and Quant have a strong buy. This is trading right there at the 52-week low, down 8% over the last 12 months. Over the last 10 years, though, it is up 42%, but we can see it has fallen drastically from its highs of $62 in August 2021. And again, another one with a fairly nice starting forward yield, 3.31%, and a very low forward P, 8.91. So it will be interesting to see where this sits in comparison to the sector. Again, 89, very safe dividend score, market cap 147 billion, a mega cap company. And again, reaffirmed not too long ago, dividend cut looking highly unlikely. In terms of key metrics, while they increased the dividend during the last recession, above average growth, although they did have a near recession return, negative 52%. Nice increase this year, 6.9%, nice increase on average over the last 5 years, and over the last 10 years, nice double-digit growth. And we do note 15 years of consecutive increases. Now, in terms of dividend yield theory, no surprises here. A strong double undervaluation signal on both the yield and the forward PE, and we can see the communications sector sits much higher. So again, another triple undervaluation signal for Comcast Corporation. No surprises that their dividends have been very nice, given the free cash flow payout is below 60% over the longer term. In fact, 37 in 2023, 38 anticipated over the next 12 months. Free cash flow also pretty strong. It is consistently increasing over the longer term. We do see 1 or 2 years where it is slightly the opposite of what we want, but over the longer term, and in fact into 2024, it is expecting to increase that essential upward trend. In terms of sales growth, while 3 to 7%, what we do note a little bit of inconsistencies, but overall pretty strong. 2023 0%, so not the greatest previous year. Trailing 12-month basis, though, only low single digits. So again, maybe one to look at on a deep dive and look at what management are expecting over the next 12 months. In terms of total sales, were pretty much doubled over the longer term. And again, it's similar to that previous company, Cisco Systems. They've bought back over $1 billion worth of shares outstanding. Always great to see. ROIC was straddling around that 10% level that we want to see as a minimum. And in fact, from the lows of COVID at 7%, it has been increasing year on year. So that is a great sign of improvement. Although one thing we don't always like to see is operating margin when it is effectively inconsistent. Not only that, it has been decreasing from 22% down to 90% in the more recent year, but still above the minimums we want to see. In terms of the free cash flow margin, consistently above that minimum level. So it is looking positive, both margins. Again, what we do want to see though over longer term is improvement and increases to both margins. In terms of net debt to EBITDA, what I want to point out here is from the highs of 3.18 in COVID, it has started to come down year on year, anticipated to come down even further over the next 12 months. So again, lots of great signs with Comcast Corporation. When we jump into the valuation, then today's episode, we are getting to an intrinsic value essentially of $52.11. And remember, if you do enjoy the content, it really helps the channel. Smash that like button. And if you want to be notified of videos when we drop them, do hit on that bell. Now, in terms of MOS level, well, a 10% margin of safety indicating a buy up to $47. if you believe that is sufficient for this corporation. 15% up to 44.30, and again we keep going till we get to roughly what it is of the current value. Not a 30% level just yet, but we can in fact see at least a 25% margin of safety today. In terms of Wall Street, well, they also see some massive upside, 27% in fact over the next 12 months, with their price target at $47.47, again indicating one for consideration. But as we do go along, as always, let us know your thoughts whether you're buying or whether you are putting it on the watch list. We then draw your attention to General Mills, ticker symbol GIS, and we have one buy rating from Seeking Alpha and a double hold from the other two analysts. Forward yield 3.6%, forward P just under 15, and again trading towards their 52-week lows. We have a poor performance over the last 12 months, down 19%. Over the last 10 years, though, it is up 20%. And again, we can in fact see their all-time highs not too long ago, around $91. In fact, we can see around 1 year ago. So let's take a look. Dividend safety score, no surprises, very safe 90. Market cap 37 billion, a large cap company, and reaffirmed towards the beginning of the year that dividend cut does look highly unlikely. Now, last recession, well, they increased the dividend. They had pretty much flat recession sales, and they significantly outperformed the S&P, -12. So you could call this a very strong recession-proof stock based on historical data. Nice increase last June, indicating we are expecting a dividend increase from General Mills this month, 2%, so pretty poor over the last 5 years. Over the last 20 years, 7% per year. Now, what we can see is 3 years of consecutive increases, as they did essentially maintain the dividend for some time, as we can see from the graph above. But in more positive news, they have been paying a dividend for the last 125 years without a reduction. Now, dividend yield theory, again, double undervaluation signal, both yield as well as forward P for GIS. But what we also want to point out for the triple undervaluation signal, consumer staples sector does sit much higher at 17.3. Now, when we look at the free cash flow payout, it is below 70%, so we do extend this above for consumer staples. In fact, not even that much higher than 60% over the last 10 years. 61% in 2023, 49% anticipated over the next 12 months. Free cash flow payout, while inconsistent, but it has been increasing marginally over the longer term. Nice to know over the next 12 months, this is anticipated to increase very sharply. And what we can see in terms of growth, the last 6 years have looked fairly positive. In fact, just the last 2 years, 5 to 6% within our 3 to 7% level. But as always, when we look to a trailing 12 month, we can see a drop down to around 1% year on year increase. In terms of total sales numerically, well, it's always important to factor in inflation. This isn't a company that is growing fast, but you would like to hope year on year a minimum of an inflationary increase to their top line. In terms of shares outstanding, they have done share buybacks, but also note they have issued shares. The thing though is, over the last 10 years, the net position would be share buyback. We then look at the ROIC, nice to note above 10%. Again, if you want to be industry specific, above 12% for consumer staples, which they have been. Nice to see a 15% trailing 12-month basis figure. And in terms of the operating margin, well, very consistently above 16%, 19% on a trailing 12-month basis. And with the free cash flow margin, very consistent, pretty much 11 to 15% year on year, 12% on a trailing 12-month basis too. Finally, the net debt to EBITDA, it has come down from the highs of 4.93 in 2018. Now, for consumer staples, below 4 is the target. 2.8 2023, 2.8 expected over the next 12 months. So again, it does look safe. So does the dividend, and the balance sheet does look secure based on this information. So let's jump into the intrinsic value. And as always, you can grab a copy of this model by clicking on the pinned comment below and getting to your own intrinsic and acceptable buy price of all your companies. Intrinsic value then, with a margin of safety at 10%, leading an acceptable buy up to 67.37. It isn't quite there yet at a 15%. So for General Mills, we would say between a 10 to 15% MOS level. In terms of Wall Street and their forecast, well, they see 13% upside, $74 for their price target. And as a reminder, we are expecting a dividend increase over the next few weeks with GIS. As always though, let us know your thoughts on these stocks. Are you looking to add any of these 5? Maybe you've already started to buy them. Maybe they're on your watch list, or maybe just for whatever reason, they're not something you're considering. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.